For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
Today marks the ending of 3 quarters of sending out the Saturday send out to subscribers, and it also marks the day that we hit 43.33% returns over those past 3 quarters and 21.96% year to date. Find out more about it today.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to wait.
All right, everybody, welcome back. Or if you're just joining us, welcome to the Simple Side. You're, of course, reading or listening to the Saturday Send Out podcast. We're glad to have you with us. I just want to remind you, whether you're listening to the podcast or listening to the podcast and reading along on our newsletter website, we have a survey that you can fill out that tells me what you want to see in this weekly newsletter, what you want to hear about in the podcast, and I want you to fill that out. You can find the survey at thesimpleside.substack.com and click on the most recent article that we've sent out, and you'll see a big button there when you start reading that says Start Survey. Click that and let me know what you want to see updated in today's podcast or newsletter. So far, we've made 27 updates thanks to your recommendations. That includes a daily newsletter that is $1 a month. That's it, $1 a month or $10 a year. That shows you daily fundamental and technical analysis on multiple stocks, a minimum of 3 every single day. So go and subscribe there as well if you want to get that information. As always, today we're going to talk about some current developments that are going on within the newsletter and our website. We're going to talk about our portfolio returns and our updates on portfolios. Then we're going to talk market trends and our commentary on the market. Then we'll get into politician trading, insider trading. We'll talk how gold is performing. And then we'll talk about the stock that I sent this week as a Berkshire buy stock. And of course, if you haven't read those articles, you need to go and check those out. You'll hear about that later. Then of course, for paying subscribers, they are able to access our weekly buy summary. That's of course the same thing that I referred to earlier, which has 43% return since we started doing it 39 weeks ago and is up over 26% year to date. They'll also get a look at some mergers and acquisition stocks, our top stock investment ideas, and then micro cap stock picks as well. We even have a little bonus at the end that shows you earnings that are coming up and options that might be effective to trade on those earning dates for those particular stocks. All right, let's talk about our updates and developments for the newsletter. As many of you know, we offer copy trading to paying subscribers. This means you can go and see my personal portfolios and say, yes, I want to buy those exact stocks. And you can do that all on our paying subscription. I send the links out usually once a week to paying subscribers, letting them know that they can go and buy into those portfolios. I've sent 2 emails out so far. If you want to be on that and you're a paying subscriber, look for an email that's going to be coming out this Wednesday. If you don't see it, you need to email me at thesimplesidenews@gmail.com and I will send you the links personally so you can get access to those. We also are developing a website right now for all subscribers to use, although paying subscribers will have access to many, many more things than free subscribers will have access to. And it is going to have things like a stock analysis report. It's going to have insider trading, politician trading, all updated daily. So make sure to join the paying subscription list if you want access to all that. My final update is that we are going to start doing our raffles again. Last year, we gave away over $4,000 in total to paying subscribers. And I included a little screenshot of what our last winner said, and I'll read it out to you on the podcast. He said, I'm a relatively new subscriber to the Simple Side. I started off by looking at some articles and realized that I should subscribe. There are 3 things that stand out for the Simple Side. Simplicity, and then he makes a comment here. How thorough they are, makes a comment there as well. And then how refreshing the newsletter is. And at the end he says, I am so thankful that I found the Simple Side. It is helping me to look at my own investing philosophy and refine/reshape so it'll be more rewarding. And I'm super glad to have people like that subscribed and listening to the newsletter and the podcast. All right, now it's time to get into the good stuff. We're going to start talking about portfolio returns. Currently, we have 3 portfolios that we talk about on the newsletter. We've got our flagship fund, our contrarian trades, and our weekly stock picks. Now, our flagship fund is down 14.02% year to date, which is behind the SPY, which is down around 10%. Our contrarian trades portfolio is up 42.54% year to date, and our weekly stock picks are up 21.96% year to date. So if you're invested in each one of these portfolios or you're following the trades for each of these portfolios, you would be up 16.82% year to date, which is an incredible outperformance of the market, which I said before is down over 10% year to date. Now, today marks the end of 3 quarters of reported and tracked weekly trades. Again, that's what I send out to paying subscribers in today's newsletter. That's 39 weeks of sending out these emails every single week, reporting back on returns. And over those 39 weeks, we have outperformed the market and outperformed even our own expectations. I am so extremely excited to see how we finish out the next quarter, which will mark a full year of doing these weekly trades. Thank you all for joining us on this journey. Now, if you've been subscribed for a while and you've been reading these newsletters or listening to the podcast, you'll know that I've been telling subscribers for weeks that our weekly trades portfolio should be the one to watch and pay attention to as the market is going through a downturn. Passive investing fails when the market is going down and trading outperforms. That's not always the case. When the market is going up, passive investing tends to outperform traders. But until the markets get stabilized, we are going to see weekly trades outperform the other portfolios. Now, for the past 13 weeks, my weekly trades have averaged a 1.41% return. And over the same period of time, the SPY has averaged a negative 0.56% return weekly. And it sounds crazy, but all of this has been tracked thoroughly every single week. And our paid subscribers get access to a spreadsheet that shows our performance versus the SPY every single week for the past 39 weeks and how everything has performed. Now, I'm going to continue to DCA into all of my portfolios, but I'm adding less money than typical in holding more money on the sidelines. I would say I'm currently 50% in the market, 50% in cash currently, and that's sitting in a high yield savings account earning about 4% annually, which is currently outperforming the market. Now, last week I mentioned that Waste Management and Philip Morris, tickers WM and PM, would be safe havens for people looking for less volatile, solid returns during the current instability in the markets. And last week, both companies had solid gains, Waste Management up 0.67%, and Philip Morris returned 5.91%. So trust me, I know what I'm talking about during this time of uncertainty. All right, this is where I'm going to implore you to go and look at the newsletter. If you're just listening to the podcast, I show how our weekly picks have outperformed the S&P over the past 39 weeks. There's a graph here that shows you the outperformance and what your value would be if you invested $10,000 and copied all the trades since I started doing this. And I also show you all the returns over the past quarter and the stocks that we had this past week. But now we get into even better stuff here. We're going to talk markets and our outlook on the markets. I give you a quick graph here that shows you the total market cap of the US stock market, the 1 week total returns for all sectors, and then the market cap performance for each sector. So you can go and check that out. Now, currently the year-to-date projected returns for the US stock market are 1.9%, which is equal to last week's expected returns of 1.9%. This week in the markets, it has been typical. We saw the SPY ending down over 2%, and most stocks were actually up in the markets, which means that mostly mega cap stocks were the ones struggling. We saw 6,743 stocks with gains, 2,668 stocks with losses, with median returns of 3.13%. Now, I have been watching 2 stocks gauge the market, and I mentioned them earlier, Waste Management and Philip Morris. Both operate in recession-proof industries, although nothing is completely recession-proof. Tobacco and waste management, of course, are those industries. No matter what happens in the markets, people are likely going to continue purchasing addictive substances. Obviously, that's what Philip Morris offers. And people are going to likely continue to pay to have their trash removed. Waste management is not going anywhere. I'm paying attention to these companies because if they continue to grow rapidly, it means that there is smart money behind the scenes that is moving into safe, quote unquote, safe stocks in the market, which means they expect more downward pressure on the stock market overall. And I have said every week that we need to be paying attention to earnings reports, paying attention to revised data metrics coming out of the Fed as well. We likely won't see the effects of tariffs this quarter, but next quarter, or if they're finally implemented before next quarter, we're going to see earnings fall, and that is where we're going to see a larger drop-off in stock performance. All right, let's jump into how sectors have been performing. This was a request by a subscriber, which is why you should go fill out that form and tell me what you want to see. The top 3 weekly performers were energy up 7.41%, Basic materials up 5.41%, and healthcare up 4.46%. Of course, the bottom three performers were industrials up 1.48%, technology up 0.87%, and consumer cyclical up 0.39%. Now, I like to remind everybody every week about Manish Prabhai, who's the Warren Buffett of India. He believes that investing in what is hated and unloved is the best road to success. So I like to cover sectors that are currently hated and unloved. These are sectors that are underperforming the market year to date and underperforming over the past month. And I've got quite a few on this list today. Communication services down 13.22% year to date. Consumer cyclical down 20.93% year to date. Technology down 22.81% year to date. Healthcare down 25.24% year to date. Real estate down 10.41% year to date. Industrials down 17.31% year to date. And energy down 14.50% year to date. These are likely all sectors that are going to outperform over the next year, or 2 years, or 3 years, just because they're currently hated and unloved. Now we can talk politician investing. As you know, I track 2 ETFs for politician trading, NANC and GOP, which track Democrat and Republican trading respectively. NANC was up 0.26% on the week, is down 5.27% over the past month, and down 11.41% year to date. GOP was up 4.5% over the past week, down 6.73% this past month, and is down 8.72% year to date. For comparison, the SPY year to date is down 10.58%. Now, over the past 30 days, I saw 24 politicians make 309 trades with a total trade volume of 6.5 million. The buy-sell ratio is currently 10.75, which means politicians are buying 10 times more stocks than they're selling, and this is higher than last week's value of 10. This shows continued bullish sentiment from politicians, which does come as a surprise given the state of the current markets. It looks like some folks up on the Hill believe in Trump's plan. Now, the 5 most recent trades can be seen in the newsletter. Again, you can go find that at thesimpleSide.substack.com. We had 3 buys and 2 sells. 1 sell was between $500,000 and $1 million worth of BWI in stock, which is an insurance company made by Scott Franklin, a Republican out of Florida. So go and check all of that information out. Now let's talk insider trading. We track an ETF here as well. That ticker is SURE, or what I refer to as SURE. SURE was up 2.47% over this past week, down 6.54% over the past month, and is down 10.22% year to date. The monthly buy-sell ratio for insiders is 0.44, higher than last week's 0.40, and above the 5-year average of 0.36. This indicates a slightly bullish sentiment from insiders as well. Now, we also cover the 5 largest trades from the past week from insiders, but I like to cover 2 transactions in particular to show you why insider trading is very important to pay attention to. The first one we're going to cover is John B. Hess. Now, John B. Hess just bought Goldman Sachs, and Goldman Sachs is less than 1% of his current portfolio. And this shows why paying attention to insider trades isn't always the best option for you looking to buy stocks. If it's just 1% of his portfolio, it probably doesn't matter that much, and he's not 100% focused on whether or not Goldman Sachs is really going to outperform. It's likely just a staple to put capital into, and he's probably expecting mediocre returns over the long run. Now, a trade that was much more important and likely is going to have a much larger effect is Arturo R. Moreno's buy of CCO. CCO is 98.25% of his current portfolio. So basically, his entire portfolio is invested in CCO. Now, when Arturo trades, he has an average 1-month return of 4.40%, and 3 out of 3 transactions outperformed over the past month. Now, his 3-month average returns are negative 1.68% with only 1 outperforming trade. But over the past year, he averages 18.67% returns with 1 outperforming trade. That means that over the long run, he tends to outperform. In the midterm, he tends to underperform, and in the short term, he tends to outperform as well. Now, let's talk about his buy of CCO because I think it's interesting. CCO looks criminally undervalued, but comes with an extreme risk setting. The price is very volatile, and the company is carrying debt levels that are far too extreme. Cash to debt is 0.02. They also have declining revenue, and they're issuing stock too. This does not look good for CCO. However, the company has had incredible insider buying. Even Stephen Cohen is buying this stock. This is going to be a next week buy. Paying subscribers, you can see below, for this stock, and it may make an appearance in our contrarian portfolio as well. All right, let's jump into our gold tracker. Last week, we noted that an ongoing trade war, worries about a soft US dollar, would likely keep gold anchored in the upper 3,000s, with support around 3,000 to 3,050 acting as strong floors. This week, we saw that play out perfectly. Gold pushed a fresh high near $3,357 and ended comfortably above 3,300, which confirmed our outlook. The anticipated dip buying around these support zones materialized, and gold's uptrend remained intact despite the profit taking and policy noise. Of course, if you want to dive into a bit of our technical and fundamental analysis on gold, you can go and check that out at the newsletter at thesimpleside.substack.com. We also outlay some scenarios and strategy for next week, including buy zones and stop losses and profit taking targets as well. So go and check all of that out. There's also other things that we do not cover in the podcast that you can go and read about in the newsletter. We also are covering a stock that we said is probably a buy. We sent out this week, and that stock is OXY. You might recognize this from Berkshire's incredible buy of Occidental Petroleum, which he has continued to do over the past couple of weeks and months. In the newsletter, we dive into the understandable business model, his proven earnings, the economic moat, low debt levels, and fair or undervalued companies. So go and check out how OXY, or Occidental Petroleum, performed on all these metrics and whether or not we think Berkshire made a blunder by buying this stock. Of course, paying subscribers, you can continue on down below all of this good stuff to see the buys for this next week. Those, again, are the buys for our weekly stock portfolio, which is up 43% over the past 39 weeks. We will see you next week with more stock trading information and are looking forward to continuing our growth of our portfolios with you. We'll see you then.